Asia, look at currencies, the major pairs and crosses coming up on your screen momentarily. Actually on our wall, there you go. Here's how they're shaping up in the early goings out here in Asia this day. Dollar yen 7883. The shared European single currency 12267. Rob Rennie is global head FX strategy Westpac Bank. He joins us from down in Sydney, and still with us on the desk here at the SGX is our guest host Ajay Kapoor from Deutsche Bank. Rob, good to see you. Of course, we had the awful retail sales numbers negative where the market had been expecting a tick up. Down for the third month in a row now. We haven't seen levels like this or deterioration like this since about 2008. Stocks get hammered. Interestingly, though, dollar also goes down as opposed to up, not the safety trade so much, because of expectations that this data could prompt the Fed to act sooner. We're going to hear from Bernanke coming up on the Senate when he heads to the Hill Tuesday, U.S. time. What sorts of hints, if any, do you think we're going to get?
Well, look, I think, given the data that we're getting now, and you raise a very good point in retail sales, that's 3 months in a row of negative retail sales. The last time that we saw that kind of run of retail sales was the second half of 2008. So you're seeing it in the retail sales data. You saw it in the ISM. We're now seeing it in the payrolls data as well. We are seeing very genuine signs of an accelerating slowdown in data as you go through May into June and then into July. The impact of Europe, the impact of China, etc. All of these are showing up in US data. So to what extent Bernanke gives a hint today, later on today, I think is important. Look, the issues that the Fed faces, one is politics. It's a presidential election coming up in the not too distant future now, and obviously any move by the Fed, I think, would polarize the concerns that are being expressed, particularly by the Republicans over the Fed's quantitative easing to date. It would increase the level of questioning over the success. How successful would another round of quantitative easing be when rates are so low? And also the Fed faces the added complication of just having extended its Operation Twist through to the end of the year. So to run two monetary policy developments at the same time, I think would be very difficult. But having said that, the data that we're now getting out of the US does show this deceleration coming through very, very clearly. And I think what, at an absolute minimum, Bernanke has got to say is that we're watching this slowdown very, very closely. We have all of the tools at our disposal, and if we see continuation of this process, we will act quickly and forcibly as well. Certainly the market needs that at an absolute minimum.
Yeah, Ajay?
Yeah, hi, morning, Rob. This is Ajay here in Singapore. Just very quickly on the U.S. Do you think that the potential increase in energy production in the U.S. over the next few years could have a material impact on the value of the U.S. dollar?
I think it does do, and I think it's a very good point. We're seeing a rebirth in a number of industries, particularly the industries connected to shale gas, as the power stations in the U.S. shift away from much more expensive thermal coal to ultra cheap natural gas. I think you are seeing some very interesting developments there in the U.S., and I think that's one of those sort of factors out there. It is not really understood by financial markets. The fact that the US is becoming more self-sufficient. You've made the big technology, the one-time enormous shift in terms of technology, which was harnessing shale gas and making it commercially available. I think that is a one-off lift to the US economy. It's a one-off positive supply shock that the US economy is beneficial supply shock that the US economy is experiencing, and I think it is a positive. It's not widely understood, and I think ultimately it is good for the US dollar on a medium-term basis.
Rob, in that same vein too, when the market always concentrates on the headline figure with the jobless rate, and the non-farm payrolls, and there's this concern that it sits at 8.2 and just doesn't budge. But the fact that hourly earnings are actually headed up again, I believe, is something that the market has seriously missed. Do you think that the U.S. dollar, as a result, added to what you just said, means that the greenback is severely undervalued, and when the wind comes, it's going to catch a lot of people on the wrong foot?
Yeah, look, I mean, that's our position. I mean, we go into Bernanke today with a very potential digital response. He says more QE, dollar's going to get slammed. He says no, the dollar's going to rally sharply. So going into today with a very strong view is difficult. But I do think that the market is overestimating the potential for imminent QE. And I think also you raise a good point on the data. The last 2 or 3 years, we've seen this very unusual period of strength in the data in the first quarter and weakness in the second quarter. We're now beginning to get to the point where that sort of seasonal slump in the data should start to show signs of improving. I think the jury is out there, really. I think you've got to get the July and the August data to get a real sense of whether this is a seasonal story or whether it's a real deterioration. We've got Europe hanging about in the background. That's a negative globally. Everyone's PMIs have weakened. We've got to see what the number really looks for August.
All right, Ajay, as we've been talking, I've been watching you sort of sitting there kind of frowning and shaking your head because you've been doing some work on what you call financial repression, that is negative real interest rates, which basically mean Treasury is not the place to be, equity is not the place to be, currency is even not the place to be. Talk to us about that.
Yeah, financial repression is simply the government saying, look, our debt to GDP ratio is 100%. We can't generate inflation because the velocities are falling. We can't really generate economic growth because we're all getting older. So we're going to commandeer the banking system's money by offering you, the savers, a negative real interest rate. And this way we can clip off 3% of GDP from our debt every year. We do it for 20 years. It's down about 70%, and we're all happy. This is what governments did between 1932 and 1952. So it is a 20-year period of negative real interest rates in the U.S.
And this is what's happening now as well.
Yeah, I think most of us know that we have negative real interest rate when you go to your bank, but I don't think we've recognized fully how long this is going to continue. No. We think this is a 2 or 3 years.
20-year stretch as well?
I don't know if it's going to be 20 years, but I think it's going to be pretty long. And the impact of that, if you look at history, is that, well, obviously cash doesn't do well. Government bonds don't do well. And equities they go sideways. You have to trade them. And gold and silver. Well, gold and silver tend to do quite well. And property does reasonably well. And within the equity market, small caps tend to do well, which is a bit surprising. I think because they have more leverage compared to the big guys who have a lot of cash. And so negative real rates obviously are a tax on that.
Interesting stuff. Okay.
Love it. Love it, Mark. Love it, Ajay. Real, hard, tangible. You can really get your grasp around assets, not these tangible financial whatevers. So, all right, we'll continue this